Welcome to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
Hey. How's everybody doing?
I'm trying to stay calm today. Dude, that song, man, pumps me up. Let's go. Got a big one today, boy.
I love it. Love the energy. Well, we got a good topic ahead today. It's actually a topic that I like a lot because it's something that I pretty much discuss on a regular basis. Funding options that are currently available for real estate investors. And the good news is there is a lot of funding options out there currently. So today is, Tuesday, April 28th. If you're just tuning in for the first time, welcome. If you're a regular at the Real Estate Reserve Podcast, let me put our logo up here right quick. Thank you.
Ooh.
Thank you for coming back. As always, feel free to comment. If you can comment below any of these feeds, we're currently live on Hard Money Bankers Facebook, Equity Warehouse's Facebook, the Real Estate Incubator Meetup Groups Facebook, LinkedIn, YouTube. We're live in a bunch of different places. Ian, you make sure you share this feed to as many people as you can currently, because we want to get this in front of as many people as possible. And as we're discussing and as we're going through this, got some interesting stuff to discuss. Feel free to comment below, and we will answer any questions that you have, even if it's not really related to funding or financing, which is going to be today's topic. And if you want to hop on the show, feel free to comment below, and we'll chat you a link as well, and we can put you in there as well. So how does that sound? The reason we timestamped this as April 28th is things are very, very rapidly changing in our current environment, and things that we've discussed on the show yesterday might not be prevalent tomorrow, and vice versa. So we're trying to bring the most up-to-date information that we can. So let's talk a little bit about funding options currently available for real estate investors. And we're going to go through a few different sources that you can get capital from. Now, the good news is, let's talk about the good news first. The good news is there is a lot of liquidity and a lot of capital currently available to real estate investors. Now, that being said, the capital that's available to real estate investors are from companies and firms and individuals that control their own capital. And that's kind of always been the case. The more control somebody has on the capital, the more available it'll be. And what do I mean by this? So private lenders, a lot of private lenders want to jump in this space right now because they believe that the safe investments right now are either keeping their money in cash or deploying it into residential. And that's usually always the time. So private capital is readily available. Local banks are very available and actively lending. Hard money lenders, not just ourselves at Hard Money Bankers, but other hard money lenders who have control of their own capital are still actively lending. Even larger institutional lenders are still lending at the right terms. Not everybody, but there are still out there for real estate, for real estate investors. So there's still ways to get capital for your real estate investor needs. So that's the good news. Now, the bad news is, in general, these lenders aren't as aggressive as they might have been 35 or 40 plus days ago, right? So they might not be as aggressive. Some of these firms have upped their interest rates, so they've lowered their LTVs and they've upped their interest rates. So you, as a real estate investor, depending on if you're fixing or flipping a house, if you're buying a commercial asset, if you're looking for a longer term rental product, you just need to take all of that into consideration during your buy process to make sure that the capital that you're looking for is available, and adjust it as needed. The 100% financing is out of there. The 90% of acquisition and 100% of construction is, for the most part, out of there. But that being said, we're going to go through all of these funding types one by one. So hopefully, it'll help you, kind of moving forward to know what's available and what are some good options. What I miss, Ian? Anything else besides those?
No, I think you talked just long enough for me to finish all the shares up. And I am excited to talk about this topic because we're actively going through this right now as we speak. That I think there's some strategies that you can deploy. There's other strategies that you need to put back in the toolbox and wait a few months to go back at them. And I think that we're going to go down an interesting path here and hopefully uncover some ideas for people and they can utilize them today. I think the first and foremost, and I know this is the topic that you're going to want to talk about the most, but I'm going to challenge you on it very hard when we get to it. But I know
Okay.
there's obviously a few types of funding capital, as you discussed. There's private, there's local banks, and then there's the large institutional funding. Which one do you want to start with?
Let's talk about private capital first. That's always the fun one. Private capital.
Right. And this is the one that I thought you were going to talk about the most. Now, when you're talking about private capital, you're talking about people either investing equity into deals and or privately funding the similar, a note for you, or however you want to talk about private capital. What do you think is one way to I guess first and foremost, why do you think private capital is the most important out of all the capital sources?
Well, private capital is important because it's a relationship, and you can kind of control how the deal is structured accordingly with your partner that you're raising the capital from, or you're partnering on the deal, or you're getting the capital from. And private capital, there's always a need for it. And let me tell you from experience, from raising private capital and being in this space over the last 13 plus years, every private capital investor wants to deploy capital. It's that simple. They want to be involved in deals. They all want a high interest rate return, or good or fair interest rate return, right? They want a good fair interest rate return, and they want to deploy their money as bad as you need or want their money to be deployed. Now, it's not as easy as saying, hey, you got $100,000, I need $100,000, let's match together and do a deal. On a broad level, it is that simple, but it's really not. And someone who I get private capital from is going to be very different than someone that Ian gets private capital from, because it is a relationship game. Relationship is the key to that. But more importantly, it's got to be a good deal, and a good deal based on what that capital investor wants inside their portfolio. What a good deal to you might not be a good deal for them. And that goes back to, the relationship and understanding, who they are and what their goals are and things like that. And, and I'll tell you from experience that the biggest issue that all capital investors have is they need good deals to deploy capital in. So you have to supply that good deal. Now, like I said, a good deal to you might not be a good deal for them. A good deal to you might be, cool, give me 100% of, give me 100% financing and I'll split the profits with you 50-50. That might not be a good solution for them. On the other side, they might come to you and say, hey, I'll do a deal. You put up 50%, I'll put up 50%, and then give me an interest rate return. And that might not be a good deal for you. So it's your job to undercover and figure out what the win-win situation is with that capital investor.
Right. Well, and you can see right here, somebody's looking for private capital right here live on this show. But with that being said, and I really want to deep dive this subject is because, so you're saying private capital is the most important because of the relationship. And I think what you're trying to say is really the freedom and the availability for you to do deals if you're not constrained by capital, because that's usually the choke point on most deals for a lot of people. Personally, I think any of us could go to MLS, any of the big commercial sites, whatever your industry standard is, or turn on your marketing campaign. I think we could all find a deal tomorrow. But my understanding is that you believe by having the private capital available to you, it gives you the flexibility to do what you want. Is that, within the terms of the capital, but you know what I mean? It gives you more availability, or what?
Yeah, well, everybody uses private capital in one way or another, no matter how big or small you are. I mean, the biggest, largest real estate investors out there, residential and commercial, they have some sort of private capital in their capital stack in general. Maybe they're raising debt, maybe they're raising equity, but they're using some sort of private capital, involved in deals, which they should. And in general, and this is a bigger topic that we don't really need to jump into, but in general, most real estate investors want to utilize banks. They want to use private money. They want to use hard money. They want to utilize HELOCs on their primary residences. They want to use their own cash. And they want to have access and the ability to draw on all of those as needed. But in general, everybody's very attracted to the term of private capital, but nobody wants to do the hard work to actually create the relationship and bring in the private capital investors. I mean, that was our full-time job, 100 hours a week, for the first 5 years of our business. And that's why we have capital. And, unless, if you're not currently doing that, it's not just going to jump, fall in your lap. I've heard of stories where people go on, land records and scrape data to see, what IRA or capital investor lent money to so-and-so flipper. And then they'll, circumvent them and then reach out to that capital investor and be like, hey, I got money. Well, I mean, that capital investor would be a damn fool to lend you money if that's your tactic to do that. In general, it's a relationship game. And not many people have rich family members or rich associates, first degree associates that they know that have tons and tons of capital that they can put together for a deal. But typically they know somebody that knows somebody that potentially does. And again, it comes back to a strong deal. I mean, I look at deals all day long, and let me tell you firsthand that the deals that, the majority of the deals that we look at aren't all that strong. The investor, the operator might think that they're strong, and they might be okay deals, but they're not, the target deals that you potentially are going to get any old private capital investor, to work on. Like, you might have to get some creative in a way to draw in that capital investor. Don't get me wrong. Maybe you do have a capital investor that has $100,000 and they want to joint venture with you and they give you the money and you split all the profits. That's fine, but that's not the case for everybody. So the purpose of all of this is to understand what the needs and the goals are related to the private capital investor, so you can kind of work with them. And let me tell you another, thing. Just because someone's got $100,000 and they want to lend it to you and they're a private capital investor doesn't mean you should take that capital on from them as well.
Exactly.
That's a disaster waiting to happen as well. This is a relationship game. This is a relationship game on the private capital side, a relationship game on the hard money lending side, a relationship game on your local bank side. It's a relationship game. When you get away from lending and it doesn't feel like it's a relationship, like you go to Wells Fargo and you get a mortgage, that's okay, but that's not like a long-term strategy as a real estate investor.
And there's a major responsibility to taking on private capital above and beyond financial institution or your own capital that's being deployed, right? Like there's a whole nother level of responsibility that you're taking some friends and family's money, deploying it, and you should be 100%, a fiduciary in that situation and take care of that money almost better than you would your own money. Now, with that being said, now's a real interesting time. And, you're saying go out there, go raise capital. And I think now is a harder time than ever to raise capital, just based on what the economic climate is. And people are like, I already see people putting up messages. Oh, the stock market's crashing. You shouldn't be investing in real estate. Well, let's be honest. You're probably not getting a quality lead off of that. You're not, like you said, not building a relationship. It's just a quick fire. Hey, you're doing better than the stock market. Yeah. But my question to you is, and this is where I want to push up against you, is do you think now is a good time to raise capital? And if it is, how would you navigate that process right now?
I mean, I do if you have the right opportunity that's equivalent to what everybody's seeing right now. Consumer confidence is down. Investor confidence on a small scale. I believe that smaller, less sophisticated capital investors are probably a little bit nervous right now in general. But I think the bigger capital investors, number one, they've been in this space. They know the risks. They know the rewards. They're actively doing stuff. They are hungry for deals and they smell blood in the water on stuff as well. So I just know this from the capital investors that we work with. They're hitting us up like, hey, got any more loans? I want to deploy capital. This is a good opportunity to deploy capital on the right deal. Now, again, this doesn't have to do with, there's a difference between having lots of capital available and having the right opportunities for them to do that. I do not believe that if you're looking to get a 6% interest rate from a private capital investor and have no money to contribute to the deal, and you want them to put up all the capital, that you're going to get that deal. I don't believe that. I think you could have got that a while ago. I think it's somewhat foolish for a private lender to do that, but that was available. I don't think that's available right now. I think the right deals on the right assets, structuring it the right way, could potentially work with you having risk, real risk, not just sweat equity risk, involved in these deals. So if someone says, well, I don't have any of my own money, but I have this really, really good deal, I think that's a harder deal to get done. Do I think that you can't get it done? No, I think you possibly could, but I think you got to have more skin or something more than sweat equity. I don't think sweat equity is going to cut it right now. I think there's got to be more, and that more could be like, cool. Well, I have $20,000 HELOC left on my primary residence. I can put $20,000 on a credit card at Home Depot to do some of the work. Just scraping by. And again, like, I'm not advocating to do all those things and to acquire debt. I'm using that as an example of ways to potentially appease a private capital lender. But again, it's going to depend on, the relationship, who they are, and what their appetite is.
Right.
There's a lot of private capital investors that want to put up all the funds to get 50% of the reward. And then there's lots of capital investors that want a very passive return and are willing to take a smaller rate of return with a lot less risk.
Yeah, I agree with that. We just finished up a pretty large capital raise for a building that we're acquiring. And with that being said, it was getting a little difficult down to the wire, just, and I'm transparent with everything that was starting to happen. We got it done. I think now, and I noticed something that helped us out finishing this capital raise up was that having proven data from the past 6 years or 8 years since we got started in 2012, not only a sampling of deals of who the heck we are and what we've done, being able to close deals during the beginning of this pandemic, doing deals coming out of the last financial crisis and Great Recession, and more importantly, being able to show what we've done and who we are, and being able to open our books and say, here, we're transparent. This is everything that we've done. Here's P&Ls and balance sheets, and we can prove to you who we are. I think that credibility goes a long way right now. And I don't disagree. Putting capital into the deal and treating it just like you would any other investor capital is probably a really smart idea right now. You're diversifying your risk. But more importantly, having that credibility and being able to show people a path to how you're going to complete deals right now, even though all this crap is going on, I think that's huge. And that goes a long way.
And again, if someone's buying a property for $100,000 and a capital investor is willing to put up 50,000 of it, there's lots of capital investors out there that are willing to do that. There's not going to be that many that want to put up 100,000 and bear the whole risk if you walk away from that deal. It's that simple, and it's not an unreasonable thing. People get upset and frustrated about private capital because they believe that private capital should just be given to them and let them just be the operator and just give it to it. It doesn't work like that. It's private capital is available, and there's a ton of it on the right opportunities. It's that simple.
So, and I would ask you right now, and because I think your partner Chris does it very well. He does. If you can find some of his stuff online, Chris does a very good presentation. Jason's business partner, on what type of capital investors you should be seeking based on personality types. But that's not the road I want to go down. Is that you mentioned sharks and blood in the water? Is now a time to be fearful of taking on private capital because of sharks looking to, say, gouge you out and you're giving up too much equity, or should you continue to do deals?
I mean, it depends if the deal works. Like, if it's a win-win situation, it's that simple. I mean, listen, if you raise capital from a private individual and they want 10% return or 15% return or 20% return or 100% return, work your numbers, see if it makes sense. Make sure it's a win-win situation. It's got to be a win-win. Think about it like this. Let me grab my calculator real quick. Think about it like this from a private capital investor standpoint. Everybody gets so concerned about what an interest rate is and oh, well, the going rate's 5% or 4% or 6% or 8%. This capital investor is getting 10%, or let's just say the capital investor is getting 12% interest rate return. That's easy because it's a 1 point per month if they take on debt, right? So you do a loan with a private capital investor and they give you $100,000, right? They give you $100,000 to buy your project. So you owe them $1,000 a month. That's it, right? To me, that's not a fair return for somebody who's putting up all the money or potentially a good portion of the money. They're getting $1,000, and an investor, a real estate investor might say, well, I'm doing all the work. I got all the sweat equity. I'm taking all the risk. It's like, not necessarily. They're putting up all the capital. They're getting $1,000 return. If you're flipping the house, you're going to be getting significantly more. So again, I'm not against structuring the deal that one side is top heavy compared to the other side, as long as it's a win-win relationship. And I think so many people forget that side of it. And if it doesn't work, it doesn't work. There's private capital out there at all interest rates, at all terms. You just got to get it the right way. And there's no red easy button. I promise you that. There's no red easy button. There's no like list of people, oh, hey, I'm going to call these and tell them I want money. I want private capital. It doesn't work like that. It's a relationship. Someone that gives me money is not going to give it to Ian, and people that give Ian money is not going to give it to me. It's that simple.
And I think you bring up a good point, is just as though there's not this well of private capital investors, there's also not just some book that you go and look up and you're like, this is how I structure the deal. Be creative. You bring up an interesting point. And I think if I was doing deals right now, say like a flip or something, I would probably go to a private capital investor and say, hey, let's split this 50-50. But like you said, I'm willing to give up, the 12% first and back that out of your 50%. So you're at least getting them, some sort of minimum, something along those lines, and get creative. I think now's a great time to get creative and really deep dive. And I think the relationships that you build now out of private capital investors, and you're successful during these times coming out of this and in the future, is going to give you relationships that will last forever, and put you in another level of playing field right now. So
yeah, I mean, capital that you raise, it doesn't matter if it's bank money, hard money, private capital, anybody else's money. You're more responsible for that money than your own money. Your money drowns first, not other people's money. It's that simple. And most people don't understand that principle in general. And if they don't understand that principle, you really shouldn't be in this business, and you shouldn't be raising capital from anybody, because their money, other people's money, is more important than your own money. It's that simple.
And that's a part of our pitch. It's that, hey, the investors get paid first, then the banks get paid second, then all of our bills get paid third, and then if there's anything left, we're the last ones to get paid. And I don't think people put enough emphasis on that. Let's be honest, you're pitching, you are selling, you are pitching to your private capital investors, is that you need to make sure that they understand that you're not getting paid till the end, right? Like, and that you do have sweat equity, you do have exposure. You might be doing this deal for free, but in the end, they're still making their money. And that's I think that's something that you can add to your pitch deck, and there's creative ways to depict that so people understand that you don't get paid until the very, very end.
Yeah, and a lot of people don't. And a lot of people don't understand that. It's like, well, I'm doing all the hard work. I found the deal. And it's like, you're right. Then go find another capital source, or use your own money for it. That's what it's about.
Yeah, we're in a game of risk. We're in the if game. I heard someone speak. He said, if this goes right, if I bought the deal right, if I don't screw up construction, if this doesn't fall down, if the permits go through, if this happens, if I sell it, if I rent it, if I do this, if I might make money, right? There's nothing guaranteed, and you're taking a lot of risk. So yeah, I mean, you got anything else? I know you could talk about private capital for hours. We did a good 23 minutes on it. I'm sure you could go for another hour or two on it. You got anything else on private capital that we should discuss before we move on to the bankers world? That's where I really like to enjoy my space.
Yeah, let's talk about yeah, I mean, I can go on and on. If people have specific questions, I can answer that. But let's go on, and let's go a little bit related to local banks, because I know for a fact that local banks are lending, and they want to lend, and good available projects that they want to do. Now, like we talked about earlier, pro is there's a lot of capital and they're lending. The con is they're going to be more conservative right now, which they should be.
Yeah, and I think some good news out of all this. I think that somewhere along the lines, the Fed lifted the liquidity requirements for banks, so that should help them, allow them to lend a lot more, and that should go a long way. With that being said, the private banks, and what we found, is no different pitching them than it is pitching a private capital investor. You need to go in there, tell them who you are. You need to instantly build credibility. You need to show them a proven track record of deals you've done. And then lastly, you need to show them financials that make sense, right? I remember doing a deal with a lender who we've had on the show before, and he said, hey, I'm going to need like this, and this. I said, so like a P&L and a balance sheet. He's like, oh, you actually have all that? I said, yeah, man, like that's what we build ourselves on. The day we started our business, we always said that we want to be bankable. We always saw that the key to our success. And by being bankable, it's put us to where we are today. So having those items goes a very, very long way. With that being I'm sorry, where I was going with is that when you're pitching them, you got to understand that the banks are going back to their loan committee and saying, hey, I met so-and-so. I met Dan and Ian from D&I Development, Equity Warehouse. This is what they've done. This is who they are. Here's their story. This is how they got involved. Yeah, sure, they can't choose the name D&I Equity Warehouse. We don't know how they are today. But hey,
they wear
Carhartt shorts. They don't wear. They don't show up in business suits. They're normal guys. They're down to earth guys. But I'll tell you what, no joke. That's actually gotten us further by being who we are and not lying to people and saying, "Look, man, this is what you get. We're gonna go meet you at the bar. We're gonna go have a drink and we're gonna work our deal out. We're not gonna go sit in an office in a suit jacket." And it's gone a very long way for us because they can go back to the loan committee, and the loan committee then understands that, hey, if things go sideways, these guys are going to stay involved in this deal and get the damn thing done. Tips, tricks, and hacks to get bank deals done right now, I would say, is don't go in looking for 75 or 80 LTV, super high leverage stuff. I would think that interest rates are super important right now. If you have a little cash stuck in the deals, it's okay. A lower LTV would not be surprising right now. A higher debt service coverage ratio would not be surprising right now. Capital reserves might not be surprised right now. That all those things are increasing for the banks to protect themselves because there's no clear-cut vision for where we're going to be in, let alone one day, but 24 months from now, right? Like Jason said, we document this show every day that we're on to understand where we are in the marketplace so we can go back and view this. So how do you think a bank feels deploying their own capital on their own balance sheet, not knowing where the future is? So they're going to try to protect themselves as best as possible.
And keep in mind, all lenders in general, they want to lend. They don't want to own properties. They don't want to own your particular property. Especially they look at it as a risk if it becomes a mess in the down. Most banks, most lenders, if someone walks away from a project, they're in trouble. So the collateral obviously is the most important thing that local banks and private lenders and hard money lenders are looking at. The collateral is the most important thing. But at the same time, the character of the individual borrower and the capacity, and even sometimes the credit is an important aspect because they want to make sure that you're stuck in this deal and you've got skin in the deal and you don't want to walk away from that. Walking away from a deal is awful for the bank. The bank wants to be your partner in the deal. Now, obviously, you go to a bank, they're going to be cheaper terms than everybody else. But I don't know. I think to sum up a lot of what we're talking about is there's still a lot of available capital. I mean, I see it firsthand. I see it from private capital investors I know, from other companies that I know, from local banks that I know. But at the same time, they all want to be more conservative. If anyone says, hey, you still lending? Of course we're still lending. Why wouldn't you lend? The loans that the banks, the hard money lenders, the private capital investors are lending today are better than the deals that they lent on 40 days ago, probably. They're better deals. They should be lending. Some of these larger national companies that went either out of business or stopped originating right now, I think now is a better time to do it. Now, obviously, when you don't have too much control over the capital to begin with, it makes it a little bit challenging if you're contingent on someone buying on a secondary market. And I get all that. And I'm not a naysayer on it. I believe that, in general, it's a good business model. They're able to deploy cheaper capital. But in general, you need to have control and you need to go to somebody who has control kind of on it. Go ahead.
Yeah, no, I was going to say, sorry, the point just hit me. I was resonating what you were saying. You were talking about the big boys, and I don't want to mention any names. But you guys know who the national lenders are, the big CMBS guys that go out, they borrow money from Wall Street, they issue the loans, and they go back and sell them and securitize them. That move and shake back and forth on that. Yeah, their interest rates are a little bit higher. They have non-recourse debt. They have all this other stuff. And I think this is where you kind of see the food chain, right? You got private capital that's like up here, personally, like right here. That's number one because it gives you the freedom to do the deals the way you set the terms. Then you got the local banks who understand your business. They understand who you are. They're right in the middle for me. They're the ones that are able to take the private capital out of the deals. They're the ones that understand who you are. You're the one. I just got an email today from one of our local banks that said, hey, is everything okay? You're financed with us. If tenants aren't paying, we'll do a forbearance agreement, even though it's not an FHA loan. They're working with us through the deals. They know who we are. They understand who we are. We see them every day. Then you got the big boys. To me, I'm like down here. I don't really like their process. They're way at the bottom for me. The problem is that you're just a number to them, right? You're just filling that securitization, or you're just getting their deals, and you're knocking numbers off the board for them. I don't want to say that they don't care. There's not the same relationship that you have with local banks as you do with the national lenders. And honestly, I would say establish a relationship first with a local bank. Don't sweat that non-recourse. Everyone sweats non-recourse. First off, when you sign those deals, the carve-outs, they're going to come after you anyway if they really want to. And number two, more importantly, if you're not all in on this business and willing to put it all on the line, you probably shouldn't be doing it anyway, right? Like that's how I see it. If you go out and you're willing to sign and do whatever the heck and do all this work and not put your life, more or less your life on the line and say, I'm here to get this deal done, and no matter what happens, I'm going to put it together and get it done, then you shouldn't be doing the deal anyway, So who cares about non-recourse? Sure, 10,
Sure.
$20 million loans, it gets a little bit different. But for what we all do on the day-to-day basis, go out, man. Establish the local banks. Establish your private capital. Don't sweat the big boy stuff. They're the ones that are turned off right now, and you're dead in the water,
Yeah, I mean, there's always a time. I mean, let me tell you, when we were raising private capital, even to this day with some of our private capital investors, they would look at some of our deals and be like, why would this person who's so qualified, who has a lot of cash, why would they use hard money and pay high interest rates? It's like, because real estate investors in general need to diversify into different avenues of where they get capital from. They have banking relationships. They have HELOCs on their houses. They have cash. They have, private capital. They use hard money. And depending on what time and place the deal works, it works great. If you have a guidance line, or you have some sort of line of credit with your local bank at 5 or 6 or 7%, and you have a project that takes 30 days to close, by all means use them. They're the best, could potentially be the best option. But you might have a deal that comes in that you're going to lose out on that opportunity, and you pay your 13% interest rate to your hard money lender, or your 12% interest rate to your private money lender, because they can move quick. So that's the reason. Like, assembling a team to have multiple capital sources, is where it's at. And unfortunately, if you don't have a ton of resources right now, this is when the hard work comes in to get the resources. Go out and figure out ways to raise a little bit of money. Go out in ways, and you can listen. If you ever heard the term capital stack, these big development projects and these bigger commercial projects, they use something called a capital stack, and there's multiple lines. They're getting bank, then they're getting additional debt, then they're bringing in private equity, and then they're bringing in other things in order to get this $100 million project put together. Listen, you could do the same thing. You could go get, okay, cool, my local bank's going to give me a 60% LTV, so 60 grand on 100 grand. Then I have this guy, he's going to put up $10,000. I have $10,000, I'm going to put up that, and I'm going to do this and this, and all of a sudden you stack the deal together. Is it ideal? No. Is it a pain in the neck? Of course. But if that's what you have to do to grind to get a deal together, if it works, if you don't have much capital, don't go look for a $500,000 property. It's that simple. It's not just about how much capital you need into the deal up front to go to closing. You got interest payments, you got construction overages, you got reserves, you got other holding costs associated with things. So many people don't realize that. They want to just go buy multiple properties and lever up to the T. Go do one good deal and work from there. And if you do it that way, there's a lot of capital available. Ian, should we go through Rodney's question?
Yeah, I got to follow it along.
Rodney, I don't fully follow this either. So the numbers are, and I'm happy to throw you on this, you can hop on here if you want. We can send you a link.
525.
The numbers are
600,000.
So, okay. So you're buying it for 525. It's got 600 in rehab. I'm assuming this is in DC. We're putting 75 grand cash in and then 1.1 million total. So does that mean that you're getting a loan of 1.1 and then your cash to close at 75, or you're just doing 525 towards the bank's just giving you 525 towards the purchase and you need 75 cash in?
I think he's saying, you said he's ready. Try private lending.
Right.
But it seems like it seems like whatever the building, it's a commercial building. You didn't say where it was, but it seems like they're all in at 1.1. I don't know what happened. And that
Ronnie, I was in downtown Baltimore. Ronnie, I got to figure out how to get you a link to hop on the air.
actually, I can do it, Rodney.
How can you do it?
Keep Rodney. I'm going to send you a private message from my personal Facebook. But before we jump into this, I love Baltimore. There was something else I was going to tell you before we get derailed here.
That's okay.
Sorry for the silence, everybody. We're not that advanced. There you go.
So
I need a link to hop on in. We'll see you back.
We'll hop. Make sure your audio is working when you hop in. So, Michael, I'm in Texas. We're getting hit with oil and gas layoffs. Can you talk about how to pitch investors on why real estate is worth investing in now? So, again, the capital investors that you want to pitch, obviously the ones that understand real estate investing in general. You know, a lot of times, this is a true story. In 2007, when we started, when we were out there raising capital, a lot of the investors that we were pitching were other hard money lenders as well. And the reason why is everyone wants good deals to invest in. And a lot of them had more deployable cash than they had good opportunities. Typically, most people have more deployable cash than good opportunities. The right people that you want to be in bed with, they have more, you know, they always want to get involved in every good deal. At our company, every good deal that we believe fits the mold, we're going to fund. It's that simple. So the purpose of the point of this is a lot of these hard money lenders were lending out at whatever they were lending out. And then they were like, well, listen, if you have any good opportunities, send them over and we'll do them as well. And they were just getting a smaller rate of return. They were getting, you know, whatever our note rate was that we were comfortable paying them on the particular deal. Ian, Rodney just chatted. Not going to get a link. So the people that are actively investing and understand real estate, those are going to be the only people that you're going to be able to pitch right now. If they don't understand real estate in general, they don't understand private note investing, trust deed investing. They don't understand that. I'd probably stay away from those passive investors currently. Now, those are great investors in the future, but they're going to, and I believe that you should create relationships with them now, because again, someone that you pitch today, you're not going to get to invest with you today. It's going to be a longer term process. Hopefully it's not going to be, you know, a year process, but it's going to at least be a month process, or maybe it's probably about a month or a few month process. It's not going to happen overnight. So if you have a deal that needs to close today, it's probably not going to happen overnight. There, Ronnie, you should be able to click on that and see. So I would say someone that understands this game to begin with, and they just want good deals. Now, again, it's got to be a good opportunity, like a really, really, really good opportunity.
Yeah, and I think before the SEC comes breathing down our neck here, I mean, look, in the end, you're more or less, I can't use the word security, otherwise the feds will be knocking at the front door, right? But you're selling them something, you're presenting them something that's more stable than what you're doing now, right? And that's why a lot of people like to compare. That's why they like to compare to the stock market, because the stock market is very easy to watch go up and down, or I guess oil is probably easy to watch go up and down. You need to show them why real estate has worked. Why has it worked through the ups? Why has it worked through the downs? How has it worked for you? How has it bettered your life? How has it provided stability to your own personal portfolio? And you really need to message match what the investor is looking for. Hey, are you tired of the uncertainty of oil? Do you not know where the next oil crisis is coming from? Sure, there can be a major upside, but the downside is way worse than what the upside is. And in the end, real estate provides a nice, level, stable return. And this is how we do it on a deal-to-deal basis. And if you don't have deals that you've already done, go out and find deals that you would have done and show them how you would have done the same exact deal.
Yeah, exactly. Relationship game. All right, Rodney, we're going to bring you in. What's up, man? How are you?
Hey, what's up, guys?
Hey, what's up?
Hey, I'm Jim. He's a real estate
Hey,
attorney.
Jim.
Practicing since the 90s.
Nice.
And, I'm Rodney Augustine. So we have this. We're looking for some feedback because I tuned in and I just you're well experienced, seasoned vets. I can tell, and we would just like some feedback.
Sure.
So We have a building under contract right now. Is it okay to say the address live or?
Yeah,
So it's up to you guys.
Okay, so we have the building under contract, 233. We're down to Lake Mason. That's where we are.
Yep.
So
Okay.
if it's a little staticky with 23 floors up. So
Yep.
we have a property under contract, 233, 235 North Howard for 525. We got the comp back and it's coming in at 2.3. It's next door to the $44 million development of Lexington Market. We know it's right next door. It's Howard and right across the street from the subway station, Saratoga.
Yep.
So we got approved by Block M Investments for 525. We've done a number of flips with Neil Roseman, Block M Investments. Are you familiar to Mark Horowitz?
No, I'm not. No.
Okay, yeah, that was a guy, Mark Horowitz, I used to deal with a while back in Intrepid Lending. So what he does is he forecloses the properties, and I pretty much buy them, and we sell them out. But the deal that we asked for feedback on today is Howard Street. How would you approach that?
So, well, a few questions. So I wasn't sure if you're trying to get rehab capital as well, or you're just buying for 525, putting down 75, and Neil's going to put up the rest.
So I thought about this. I thought about raising the construction $100,000, and basically, I don't know if I raise the construction, maybe I could raise the value a little bit. But what I'm trying to figure out is, okay, I got approved for 525, but we need purchase. So I'm looking for a partner that wouldn't mind being second to the purchase, because it's a 6-month project. Yeah, so like subrogate. Yeah, would they subrogate the two, or how would it look? I don't know how to do the deal.
So you're saying Neil's going to put up 450? Neil? Is that right? I know Neil.
Oh yeah, that's my dog. Yeah,
I know Neil very well. So all right, so he's going to put up 450.
Well, 525. He's putting up 525. Neil's putting up 525. I have a bunch of current projects with Neil. I'm cashing them all out.
So, all right, so let's just say, okay, so he's putting up for the most part the purchase money, and then you're just looking for private.
Neil's doing the construction. It's only 525. He's doing. I asked for 600. He's giving me 525, so I have to put up 75. But the problem is, he doesn't want to do the front. He wants me to put up the building money, but the building's going to be worth double that when they finish this $44 million.
So technically, he wants you to put up $600,000, and then he'll come in to layer the construction.
So I need some capital stacking from the experts here, and I'll even cut you in on it for the feedback. Seriously.
I don't know. That's a challenging one, and I commend Neil because I think he structured that the right way, because he limits his risk, because he doesn't really have much risk at the beginning until the property's underway and getting improved, because then he's coming in to draw out that money. So you need purchase money first from somebody. So technically, I guess you would have to raise private capital and then allow them to subordinate behind Neil as he comes in behind the scenes.
Yeah. See, with a building like this, Neil would only be out of pocket. True cash, he's putting up 525 on a 2.3. Yeah. So in first position, I'm looking for, if I put up half the money on the purchase, would someone come and see me? So if I put up 250, if I put up 300 on this 225, well, the rest, I got Neil pulling up in the front. So if I raise the construction, I can offset some of my costs, but I would need someone experienced like you guys to really.
Yeah, it almost seems like you want to raise equity for a project with a private capital investor, and let.
What do you think?
Let me. Hold on, we got some feedback on one of ours, so it's. Let me mute you real quick while I talk, and then I'm gonna unmute you afterwards. I just want.
There you go.
Is that better? Okay, yeah. There were some. So I'm thinking something similar to this. And again, I don't know who this ideal person would be, but somebody that you could partner with on this particular project as equity. They come in, they put up the cash, or multiple people. You raise it, 5 different people. They each put up $100,000. They participate in, maybe a new entity that purchases this particular property. Full transparency that they know that you're going to be getting debt for the construction. You just need more of the operating costs and the capital to purchase the property. So you try to raise a few $100,000, $600,000, whatever it costs, in order to get into that. Hold on, I got you muted, so I can't hear you. So you raise money, you buy the property. Soon as you buy that in the entity, then you go to Neil, you do the refinance. My guess is Neil wants 525, but he's probably not dispersing 525 up front. He's probably dispersing it in draws as you're improving it.
Yes.
I just want to unmute you. So the tricky part's going to be to try to structure a deal to try to get $600,000 in private capital.
Would you have a partner that would be open into what if we did an equity split on the refi? So, for example, if your client met me halfway on the building, we subrogate the mortgage, and then we pay them out of the refi. So I was thinking the easiest way to do this deal would be to sign a person on the LLC to protect their interests, and then he could draw up the docs to limit the distribution.
Yeah, but you're not during the refi. That's not going to pay off that front end person because Neil, they're going to have to. It's going to be the ownership. What's that?
Never mind. I don't want to say that. I was saying, if possible, if the person is interested in signing on the LLC and being part of the entity, and then Neil pulls up with the 600,000, well, it's 525. I got to put up 75. I think the deal could work like that, especially on something that's worth 2.3. And it's an old bank. It's the old bank on the corner.
Yeah, I see it.
So it's already zoned out. It's 13,000 square feet. So
yeah, 233, the white building. Very familiar with it.
No, it's brown.
With the brown
brick building.
Yeah, I mean, listen, it's a matter of finding somebody who's got a comfort level who wants to partner with you on a particular deal. I mean, like I said, private capital investors that would invest with us might not invest with Ian or you, and vice versa. Your capital investors might not invest with me. It's just because it's a relationship. They got to see the vision of the project. I mean, if that was my project, I would probably go out and try to find a few smaller chunks, maybe $100,000 a piece, of somebody who wants to own that property with you. And it's just a long-term play project with them. Obviously you could work out deals on the back end if you want to refinance them out in the future or pay them off with proceeds. But for the short term, work it in that, everyone who comes in and puts up $100,000, whatever, gets 15% interest. And then you get, I don't know, a few people or 10% interest. Let's say you get 5 people put up $100,000, then, 50%, you own 50%, they own 50%, something like that. I mean, Ian's done projects like that. I haven't really done too much stuff like that because we've always just been straight debt, not equity.
Yeah. So there's two things. If you want to protect your equity position, if you have any, I'm sorry, I'm like looking between two screens here, but if you want to protect your equity position, if you had any other properties that you could cross collateralize against, like you said, hey, I'm liquidating my portfolio. So this way those investors get taken out first. There's a possibility that you could do that and cross collateralize, and this way you retain all your equity. And then they're getting an added security for subrogating and being in second position. If you really want to protect your equity position, you don't want to give up any equity, I would offer a considerably higher interest rate for second position because there is risk. And fully, obviously, you got your real estate lawyer there that you can fully explain to them that they still have rights and positions in second position that they're not getting, that they're just not going to magically get wiped away. They still have a chance to protect themselves. Lastly, I'm with Jason on this one that I would be giving up equity. I would probably be trying to find a partner that's willing to be with you on the deal, potentially in the refinance, potentially give them a personal guarantee fee. You get like an acquisition fee and a development fee. That this way you might be giving up equity, but you're still scraping fees off of the deal. And this goes back to the private equity, a deal like this, you can charge an acquisition fee, you can charge a development fee, you can charge a planning fee, a due diligence fee, a refinance fee, and still give them everything that they want. You can still give them a preferred return with a fatter equity split. Sure, your payout in the end is going to be less, but you still have you're getting more money up front, and it's a win-win situation both for you and your investors. I'd be curious to peel some layers back on this deal and truly understand what the redevelopment looks like. But it's interesting, and I think there's a way that you can structure it, especially now for people looking for long-term stability against what they're getting in their IRA and portfolio right now. I just like the front of the building.
Yeah, he fell off the feed, but that's okay. His internet might have shut up. Dave Bauer wrote, so he's in need of a gap funder. Yeah, in essence, gap funder. I mean, more gap funders are involved on smaller scale projects where, they go to a hard money lender and, they get $100,000, they need $40,000, and the gap lender comes in and puts up $40,000.
Yeah,
or gap funder.
Yeah, the always call it mezz.
Yeah,
right?
I think that's going to be hard for him to get debt on that deal, but behind Neil's debt, or besides Neil's debt, I would say. And I think Neil structured that deal perfectly, to be honest with you. I mean, he's not going to have much risk at the beginning. And then, as the deal gets developed, Neil will extend them, construction money and things like that. So,
I know because that Howard Street corridor is getting redeveloped, so it should be interesting if you can make it work. I know they're doing the big redevelopment down the street on that white building. But anyway,
And also, like, keep in mind, in general, there's a lot of people out there that aren't private lenders or aren't private investors that still potentially want to be involved in deals that have some capital. There's nothing wrong with, having a real estate investor reaching out to one of your friends that's a real estate investor, and maybe they have a HELOC, maybe they have a line of credit on their house, and say, hey, you want to be involved in this project with me? And I think the equity participation play is the one to go on something like this. I think it's going to be too hard to structure any other type of debt with it. All right, Ian, where were we on funding sources? Did we finish that? I forget.
I don't know. We just covered every single funding source we could on this one deal. There's a million, and that's the advantage to knowing all the funding sources between private capital, banks,
because some deals you need them all in.
Yeah, the other thing I'm thinking real quick is maybe you can give Neil a higher interest rate and go out and get a bank debt up front and get Neil to subordinate if he's willing to do the deal and reduce his exposure and increase his interest rate. There's a potential that you could do that deal just like that. But yeah, so anyway, I think we covered them all, and that deal really just summed it up. That was awesome that we brought them in. And I think going forward, if anybody has comments and you bring value to the show, we're going to bring you on live here. In the end, man, it's all about what you're comfortable with, and if you're willing to take on that debt, not personal finance, private funding, bank funding, big boy funding, whatever the heck you're going to use, you're still on the hook for that money. And if you're not going to be able to sleep at night because you borrowed grandma's retirement plan and it's going to make you sick to your stomach, don't borrow it. Straight up, just don't do it. You know what I mean? If you're going to lose sleep over it and you feel like shit about it, don't do it. If you're going to go to the banks and it's going to keep you up at night, go all cash. Don't get debt. Don't lever up. Nobody says you have to do this.
I agree.
We went down that road. Yeah, lever up, lever up, lever up. At a certain point, you're like, shit, man, like I'm levered to the hills. Is it really worth it? Or should I just pay debt down and just have a nice portfolio? I don't need to be the biggest portfolio on the street. I don't need to be the guy with the private jet. I just want to have a nice portfolio that cash flows, because that's the name of the game in the end of this. So
yeah, and again, believe me when I tell you, if you're not levering up on these things and you have additional skin to put in and you have lower LTVs, you're going to be able to get capital a lot easier from your local bank, from your private capital investor, from your hard money lender. And go ahead.
No, I'm sorry. That deal right there, prime example. If we weren't levered to the hills, a deal like that, I would go to the bank and say, okay, this is what we want for financing, cross-collateralize our portfolio. We're willing to put it on the line and go. You know what I mean? Like, that's the advantage of having no debt on some properties that you own,
Yeah, exactly. And we didn't really talk too much about the hard money side. We talked more about private capital and local banks in general, but the hard money side is the same thing. It's the same setup. Yes, there's a little bit of a relationship. Yes, the hard money lenders that have control of their own capital are still all lending. They are. The ones who lost control of them might not be, but the ones who have control of their capital, they want to lend, and they are lending. We're still lending very actively. But again, the hard money lenders, along with the private capital investors and along with the local banks, they're being more conservative. They should be. We all should be. You should be more conservative when you go buy a property right now.
Yep.
In general, everybody should be, and find the better opportunities. Keep in mind, we haven't seen enough in the market right now. There hasn't been enough pain from buyers or sellers. There hasn't been enough pain from landlords. We talked about April 1st being a big date related to mortgages being due and rents being due. April 1st, a lot of positive things still happen. People still paying their mortgages, and tenants and residents still pay their rent. May 1st is another big month to see what happens there. So it's not like there's these home run deals out there right now. There will be in the near future, but banks and lenders are kind of on edge trying to figure out where they want to be at. I mean, in general, we've cut our LTV down about 10% just to be kind of on the the smart side, to be safe. But people are still lending. I don't think you're going to get 100% financing or 90% financing. We start off the show that says the 90% loans with 100% construction, 90% acquisition, 100% construction is not there. It's not going to exist. I don't think it's going to exist. And I do believe that if some of these larger institutional backed note buyers or larger institutions and capital sources come back, which I believe some of them will, don't be surprised if the interest rates are higher and the LTVs are lower.
Yeah,
it's just that simple. I've talked to a lot of people that can't swallow the, hey, I'm used to my hard money lender giving me 8-1, 90% of the acquisition, 100% of the construction. I can't swallow going with a hard money lender that uses their own capital or uses only private capital and it's more expensive with lower LTV yet. They can't do that. I'm like, okay, when those guys come back, they're not going to come back and leave off where they were. They're going to come back and they're going to be more conservative.
And I think it's the universe looking out for you, man. They're saying, slow down. You know what I mean? If you don't have the capital to do the deal right now, don't do it, man.
Exactly.
It's very easy to get in trouble,
I've already seen behind the scenes on some of the terms. Hold on, I got to switch this headset. Can you hear me?
Yeah,
Is that better?
Yeah, we were supposed to do a short show today. We're going an hour.
I know you killed my AirPods. They weren't even fully charged.
I got a piece since we went live. So.
What was I going to say? But I've talked to some of them and I've seen behind the scenes of what they're doing. Their interest rates have gone up and their LTVs have gone up.
I think your phone is still connected. Go into your audio settings, change your audio settings up. As you guys can see, this is real live stuff. We're screwing up right in front of your own face. Nope, can't hear you. Check 1, 2. Oh, shit. There goes the show. I'm going to have to leave the closing. Come on, man. Get it together. No? Hello? Jason ruined the whole show. I'm here by myself.
Stop.
There you go. There it is.
Jeez. No, but I've already talked to them. I've a lot of them, and I see what the interest rates are. I see what the LTVs are, and they're the same as private capital or hard money lenders were. Maybe a little bit better, but not much better. So that's the whole thing. Is you just got to adapt and pivot to what's available. And if the numbers don't work for the investors, then they don't work for the investors. But there's a win-win. This whole thing is about supply and demand, right? We talked about this when we talked about this when we started. We talked about if you're raising private capital, it needs to be a win-win. For you, it might be, hey, I want 100% capital. I want 100% financing with 6% interest rate. That's a win. For you, that might not be a win for the capital investor. The capital investor might say, I want you to put up half the money and pay me a 12% interest rate return. And you might be like, well, that's a win for you. That's not a win for me. And then you meet in the middle and you figure it out. That's where all this comes in at.
100%. And if you're not willing to do give and take, you shouldn't be asking people for money. Tyler Frank hits a home run here. If you don't have the capital, don't do it. I was saying that earlier. It's exactly why banks only want to lend to people that have money and don't need it. A lot of that statement's true. You should have capital. You should have skin in the game. And it protects both sides. Honestly, it's not just protecting the bank. It's protecting you. It gives you that comfort level that you're not over levered to the hills, cash flowing, whatever your minimum is, it puts you where you need to be. So Don, welcome to have you as a new investor. I'm glad you're enjoying.
Yeah, let me go through all the, want me to go through them or you want to real quick?
Go ahead.
Rodney, thanks for hitting us up earlier and hopping on. That was good. Rodney, we talked to earlier. Appreciate it.
Yeah, I thought that was Jim Holderness that was on earlier.
Let's see. We went through Mike's question. Rodney's. What else we got in here?
Don.
Tyler, thanks. Jim Holderness. What's up? Don, I'm a new investor. Love this feed. Thank you. Yeah, appreciate you guys. Appreciate you.
Tomorrow, what we got tomorrow? I think we were having some technical difficulties today, and I'm glad we got to do this one because we were going to save it. But I think Rob from RPS Flooring is going to jump on tomorrow and discuss supply chain issues and discuss how he's been combating with what's going on. And how he's been able to continually get flooring in and still be able to do installs for investors and being able to keep jobs moving.
Yep. How to maximize your supply chain to efficiently get building materials currently, which is good because a lot of people are complaining about that. It's hard to get building materials for their jobs in general. Seems like there's, obviously still available, and it seems like a lot of people are just going to Home Depot and trying to stock up on everything they get their hands on. But anything that they can't get through, the Home Depots of the world have been challenging in general. And I guess that's kind of affected regionally. Is that right, Ian?
Yeah, we'll talk more about it tomorrow, but I think it is based on the region and what the supplies look like and where you're getting your materials from. So we'll bring all that together tomorrow. And dude, I really got to pee. I'm not gonna lie. You see me rocking? I'm like dying here. I'm like, should I just go under the desk? I don't know what to do. So,
all right. We'll see everybody tomorrow. Thanks again. Tomorrow, 1:30.
1:30. Yep, sounds good.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.